Hello and welcome to a brand new show of Market Makers. My guest on the show is someone who I always like to call him the little master, simply because he's mastered the art of identifying small and niche businesses, and he has the ability to really ride some of these good businesses through this business cycle. So my guest on the show today is Kenneth Andrade, someone who needs no introduction because you've seen him on previous editions of Markets Maker. Kenneth, fantastic to have you back and thank you for joining us. Should we start with the obvious part first, which is your view on the big picture?
Big picture? It's not so bad as we make it out to be. I've been fairly cautious on valuations for some time now, and I think that sustains itself. We've very rarely seen markets making you disproportionate amount of money when you start expensive. I think the underlying picture is when markets trade at these levels. I mean, I think if you're almost 20 times forward, it's you necessarily have to believe that growth will kick in, and that's the underlying belief that growth will come back in 2018 and 2019. If I look backwards, I think 2016 analysts had a between a 15 to 18% growth, and that year ended negative. 2017 there was you started the year with a similar number, and as we culminated this earnings season, growth is relatively flat. So I think if you look at price earning multiples, it may be more because interest rates or bond yields have fallen down, which has taken earning yields up. So going into the next 2 years, I tend to believe that we would be somewhere between in the higher single digit growth number in terms of earnings, and that would be probably the best case that would happen. And possibly post that, it could be significant. It could be relatively higher. Also, when you're talking about growth in the near term being single digit, what we necessarily need to look at when growth is at single digit levels is that your balance sheet repair has accelerated quite dramatically. So that's one of the biggest positives. You can't drive growth disproportionately without having a great balance sheet, right? And growth is and balance sheet and debt is still relatively high on the corporate system. So we're going through a corrective phase. I think that corrective phase is having an extended window. It's much longer than what all of us have expected it to be, and our sense is that between 2018 and 2019, a single digit growth on earnings is a great number. Look on the liability side. If you've been able to clear up your debt, if you get your financial sector back in place, they will be the next round of funders for your growth going forward.
Are you a bit surprised that the so-called demonetization effect has not really impacted the economy per se? The GDP number may be slow, but we are still growing. If I look at all the fast, high-frequency indicators, they are indicating that things have normalized.
Things have normalized to a very large extent. I think we put that behind us, and we've come back to status quo. Okay, and we'll just have to build it forward from here. We're going into another phase of uncertainty and how it will evolve itself, but from whatever I've been able to gather on the ground, I think corporate India will adjust to GST pretty in the next 6 months. There might be a little bit of disruption in that in the next 6 months, but before you get into that disruption, I think June quarter will be excellent, because you will see a lot of sales taking place in the June quarter. So June quarter could be relatively a very good quarter, especially for the consumer side of the economy. And going into the next 6 months, there could be a slight slackening off, but I think corporate India will use that period of time to reconcile their books as to how to adjust in a new environment, which is the GST environment.
The logic which has been given to us by some top local and global sell-side strategists is that there is a strong earnings recovery which is coming. If you look at historical averages, we are nowhere close to its mean, and we have to align with the mean. Why? Because consumer spending is making a comeback, global recovery is visible, and government spending has just about started. Would you buy this rather optimistic scenario?
Well, there are all the factors that are required for growth to actually pick up. Okay, I'm not a great macro guy in terms of looking or slicing and dicing each of these numbers. But what the pointers that you've actually put together: consumer spending coming back, government spending coming back. All of that is well taken, but that can hold the economy to where it is at this point in time. you necessarily need to get leverage back into your entire system, or you need the financial markets to actually leverage that entire market and actually take it forward. And I don't think our financial system is geared up to increase leverage till they actually clean up their books and take it to take it forward to the next level. So we are still in a growth phase. We are still in a moderately growth phase, but the financial cleanup that is taking place, or the balance sheet cleanup that is taking place, is accelerated. Okay, and I think that will do very well into the next decade.
So last time when we interacted on the same forum, your view was that one should buy into agrarian companies or buy into companies which are going to be enabling the rural recovery. Are you still bullish on that theme? Because stocks like Escorts or for that matter Cholamandal, they've gone up very, very smartly from the recent lows.
So without getting into why agrarian and why rural economy and why not urban economies, if you just look at the basic statistic in population versus GDP, okay, the rough cut number that we've been able to put together, and this is largely from the government websites, is close to 65% of your population is stays in rural India.
Yeah.
Okay, and they contribute to about 30% of your GDP, or they have access to 30% of your GDP, and 35% of your population stays in urban India, okay, and they account for 70% of your GDP. So if I had to play the next 10 years or the next 15-year cycle, and if you tend to believe that India has a demographic dividend, and that's the biggest play that you have, you can't grow as an economy till you don't even out this imbalance that is there. Okay, so you would see disproportionate amount of capital or disproportionate amount of GDP now getting reallocated into what is defined as semi-urban or rural economy, and that is our larger play to it all. So any business that enables productivity, any capex that goes into that entire cycle, any consumer trends that are prevalent in that part of the world, is something that we are very interested in.
Give me an example of a consumer trend which could be called as rural in nature.
So we built a value chain in that entire business, okay, and you take it from productivity in that environment. So we identify with all agricultural productivity businesses out there. Okay.
So seeds companies and agri crop companies.
So all of them put together. So you get agricultural inputs and you get mechanization, so all the enablers down there are actually put together. Then you're seeing reasonable amount of activity happening, and what's happening on the MSP side. It effectively means that there is going to be incremental amount of higher amount of money going into the rural economy's pockets, right? And that's going to enable everything else after that. So that's going to enable people to increase productivity. It may not be just farm productivity. It also will be the ability to improvise on the services economy that revolves around that farm economy. And then you'll have the consumer trends playing out. The consumer trends that will play out are very similar to what's happened in urban India. So every part of that world out there will tend to go aspirational.
So are you saying that buy consumer staple companies which are semi-rural focused?
You're getting a lot of smaller companies, and they're all in the private domain, which are actually delivering out large numbers. They might be regional at this point of time, but they've got national ambitions. So you may not necessarily look at consumer trends that are happening with large companies in large listed companies, because large listed companies still have a predominant size. The business still revolves around the urban economy and spending in the urban economy, and a very tiny part of that belongs to the rural economy. But that incrementally over the next 2, 3, 5 years will actually expand itself disproportionately.
Now, you've maintained it on various public forums that you will not buy banking NBFC stocks in the current portfolios you're managing. Are you still sticking on to that conviction, that call?
Well, I couldn't understand them 6 months back. I won't be able to say that I understand them now in terms of. So let's break them up into 3 parts, right? NBFCs, you got private sector banks and public sector banks. Private sector banks is easy. at 3 times price to book, 4 times price to book, 5 times price to book, I didn't know how to make money from there. Okay, at 3 times price to book, it moved to 4 times, then it moved to 5 times. But it was just the question of valuations actually expanding themselves disproportionately. So I would not know how to play that cycle, and we've avoided that completely. On public sector banks, this still remains to be seen as to how they deal with the entire ability to clean up their asset side of their book, which is effectively funding the large scale manufacturing stroke infrastructure business that they've been through or in the last decade or two. So that's clearly out of our that's clearly out of our bucket of opportunity that's there. The similar thing holds true for the NBFC space. We still have to grapple with what's happening on consumer lending out there. Okay, and that business has grown rapidly. So it's got growth in its favor, but it definitely doesn't appear to be very valuable for us as a business opportunity. So between value and stress on books, I think we clearly continue to maintain that we may not be looking at that in the immediate future.
But financial inclusion is a powerful thing. As India grows, as per capita grows higher, the nature of savings will also change. It will become more from fiscal to financial, and the penetration has just about started for mutual funds or for for that matter insurance. So can you afford to avoid? Forget about banks and forget about NBFCs, but can you afford to avoid even brokerage stocks like Motilal Oswal, IFL, Edelweiss? Can you afford to avoid some of these enablers?
So I again step back. The best time to buy it from a platform from an investable from investing. So these are great companies, but great companies don't make great stocks. Okay, so I'm not in the business of buying good companies and keeping them on book. I'm also in the business of actually compounding returns. Okay, so we need a business which is available at a valuation which is which we do in our definition is cheap, hit a growth momentum, and that's when valuations actually expand. Okay, so you get earnings which accelerate, and then you have price earning multiples which actually step up, and that's a part of the inflection that we continue to look at. When valuations are already at a reasonably high number, when valuation is already at a reasonably high number, I probably only relying on earnings growth to deliver returns for me.
But what's wrong in it? I mean, if you look at a stock like HDFC Bank, even though it's always been expensive, it's still been one of the finest compounding story.
So if you can put a portfolio together that actually can deliver a better return than HDFC Bank, I think you get a job well done, right?
Okay, that's what
the ideation is all about.
Fair point. That's what I think the whole construct of your scheme is, that you have to find some of these so-called unknown ideas which the market is missing them for obvious factors.
Nothing is unknown.
Nothing is unknown. It's just that how you construct the risk-reward scenario.
So look for an opportunity or look for a business which is not doing well. Buy the guy who actually leads the entire business. Okay, you're probably getting it at a price point that you would never be able to buy it if that industry was doing well. That's our business.
Would you say that is currently applicable for IT? Is that currently applicable for pharma? Because suddenly these stocks are beaten down. Is there a business risk, or you think this is just a cyclical disruption?
There's a business risk, which is why you're getting them at valuations which are there.
But is the business risk real?
Even if the business risk is real, it doesn't mean that mortality risk in that business in those companies are very high.
And would that apply for IT and pharma both?
Both. You step back. Let's put it this way: if you go back 3 years, or maybe 3 or 4 years, 3 years actually, you go back there, and the market hit a new high. It was led by pharma and was led by IT, right? Look at where the valuations was, and look at how earnings had to grow.
So are you a buyer in IT and pharma?
And look at the market right now. Yeah. So the underperformers 3 years back are actually the outperformers right now. Okay. Now you necessarily have to make a business case for the guys who are outperforming the market to continue to grow, because the risk that you are actually bringing to the table is that the multiples are already high.
Three years ago, if you bought into metals, 3 years ago, if you bought into oil marketing stocks, you really made money.
3 years ago, if you bought into valuations, you made money.
You made money, of
yes.
course. I mean,
so
HPCL, or for that matter, Hindalco,
exactly.
for that matter, Tata Steel. Yeah. But that same logic, if one buys into IT and pharma selectively right now, on a 3-year basis, is there scope to make serious money?
There are opportunities that are coming your way.
Okay.
Okay, and these two sectors probably are, these two are the mainstream sectors that are showing you that there is reasonable amount of business risk, but for that business risk that you're going to take, you're also getting it at a price point that you would probably never get it at.
Is IT slightly more easier to understand than pharma because the balance sheet, cash on the book, return ratios, they are believable?
I think both the businesses are the same.
Would you stick to large cap IT and large cap pharma? Because every time this transition has happened, we've only seen that bigger players, they get better and stronger.
I think IT, our preference is still on the smaller companies. Okay, because they've been able to move their business models in line with how the markets have been shifting. So that's where we are at as far as IT is concerned. And in pharma, I think there is a lot of investment that's gone into the ground. So there's a lot of investment, and all of that over the next year, 2 years, if you can get all that investment gone into the ground at a price, I think it answers your case. So here I just like to say, I was on this channel about 6 months back, and valuations on IT were cheap. Okay, and I said valuations on IT were cheap. It doesn't mean that in the next 6 months you're going to make it capital. So you will continue to buy into cheap valuations. Okay, till there's that inflection point when growth actually starts coming back.
But we are a distance away from growth, at least for pharma and IT. I mean, can one really construct this kind of a scenario for next 2-3 quarters?
Growth is never predictable.
It just comes automatically.
After a point in time, so demand is never predictable. Supply is, because supply, you can see the amount of supply coming in, and as long as supply collapses, and that's where what happens in a market like this, supply starts to collapse. So if you go back to the IT businesses, the amount of recruitment taking place doesn't exist. Actually, there's retrenchment. Okay, so supply is getting contained. When supply gets contained, the competitive intensity actually falls off. The competitive intensity falls off over a period of time. Now, I don't know if it's 1 year, 2 years, 3 years. You probably get your pricing back again.
You also like media. What's the broad contour there?
I think media is one of the best places to play in an expanding economy. Okay, so let's put it this way, that if you've ended up in an economy which is growing at about 7 to 8%, okay, and you haven't invested in growing your business, the most easy or the most conventional way of doing it is invest in media, and that's what most consumer businesses do, right? So if the hypothesis is right, and a large part of rural India is going to have a significant step off of per capita income, I think you've got limited inventory which is available in that space. That will get exhausted very fast. So again, I'm not timing growth out here, but the numbers stack up in my favor. The industry construct which is there, it also stacks up in my favor, because there are very few businesses out there which are solvent and which have reasonable amount of market shares.
Fair point. Now, we've had a conversation in the past where you've said that, look, you're also exploring buying into some engineering companies, because if the economy recovers, capacity utilization goes higher, and suddenly operating leverage would kick in. Are you still a believer in that school of thought?
And you will always get a company or two who will do it. Okay, and there is always a niche opportunity which is available. We're trying to play those niches. But I don't think we're across the board into buying all engineering businesses or contracting businesses. No, we're not there.
Yours is a young fund right now, and you've raised money at a time when market valuations are slightly stretched. So is that the greatest challenge for you, managing and investing in this kind of an environment where the odds are not exactly very favorable?
I think managing and investing is the easier part. Controlling expectations is the most difficult challenge that is there.
So what are you telling your clients?
So if I just look back historically, and everyone sees a 30% CAGR and a 50% return in some cases over the last 1 year and the last 5 years, a 30% CAGR, I'd like to moderate expectations going forward. It's not that if the market delivers it, I won't deliver it, but I like to moderate expectations. Is that you haven't seen valuations at this level. As a country, we basically are cleaning up our act, and this is an extended period. It's an extended cycle, but but also look at it from a global basis. The asset class itself is at its all-time high anywhere in the world. Okay, anywhere in the world. So India in isolation is doing well. We are attracting a lot of capital, but there are a lot of other economies which are also attracting a lot of capital.
Fair point. Where do you think there is a huge valuation discomfort in this market? Where do you think there is a bubble or a bust in making?
So I may not say that this time there is a question mark around whether there's a bust happening or not, because if you have valuations at an all-time high, India is deleveraging as an economy, or corporate India is deleveraging as an economy. So I do not have I do not have solvency risk on my book. Okay, so we may not be into that bubble cycle in terms of corporate earnings growing at 30%, price earning multiples at 40 times earnings, and then everything collapse, because this time the financials, the liability side of corporate India is actually deleveraging itself. So I think the best case scenario out here is valuations will continue to maintain, valuations will remain static at wherever we are, 23 times trailing, 20 times forward, okay, if we grow 15%. And the expectation on equities over the next 2 years, I'd continue to say moderated, but last year's taken me by surprise. I hope next 2 years also takes me by surprise.
But if one really puts forward this liquidity argument, which is that real estate is not making money, gold is not making money, saving rates are moving from physical to financial, the equity inflows or the SIP culture has just about started. How does one defend this kind of a strong liquidity argument, which is evident both locally and globally?
I think liquidity necessarily needs into productive capacity and creating demand, not into creating demand just for stock.
And there's a lot of supply also which is coming up.
Okay, so right now there's all the liquidity arguments that you put together is creating money for buying new assets, right? But what's going to happen, and you just alluded to it, or you just, the amount of capital that's going to go, amount of companies coming to recapitalize a balance sheet over the period of this 1 year, it's going to be humongous. Okay, so between REIT structures, between financial assets, financial companies, and manufacturing businesses, I think the appetite for capital by these companies are huge. You will see a lot of that liquidity get absorbed by these businesses.
Do you think in the short term GST could be more, and it is a long term very positive structural tax reform, but while the implementation process would be on, the teething troubles would actually have an impact on the aggregate demand and earnings picture?
I think we'll get used to it in the next 6 months. But June is going to be quite a nice quarter to watch out for.
So if you have to really construct the 3-year scenario, where do you think there is strong case for both earnings re-rating and PE re-rating?
I mean, the latter, I think we're already where we are. Okay, in terms of earnings re-rating, I've already mentioned it. The next 2 years, we always start off, and this has happened for the last 4-5 years, as long as I can think of it. We start at a 15-20% growth rate. We go flat to negative by the time the year ends. Okay, we're starting with 18% right now. I'll be surprised. I think higher single-digit growth rate, higher single-digit profitability growth will be an excellent number for India. Okay, but like I say, always watch out for balance sheet. If I had to get surprised, I want to be surprised by balance sheet cleanup or restructuring on the balance sheet side.
How has life changed for you from managing an open-ended fund for a institutional bank per se, versus managing your own scheme where you are standing in front of the firing squad because clients are asking you tough questions?
Oh, they always ask me questions.
So
I don't think life has never changed. Life has always, it remains the same. So I've always been able to buy companies and businesses where I had the conviction, and like I said, I have the option. Earlier also I had the option of buying businesses in the format that I was used to. I always bought businesses which are cheap, or companies that were stocks which are cheap, and played the life cycle, and that's the only time where you can have the patience or the stomach to ride with these companies through their life cycle. So if you got to get you got to get your stock at the price that you wanted to buy them at.
So how do you manage the NAV compulsions and price performance stress?
It doesn't change. I think I manufacture a product, and my product has got to deliver a certain expectation. If the markets are delivering a certain expectation, delivering a certain return, it will be very unfair for my investors to say I'll deliver it in the third year, right? So I get paid for it, okay, and I'm happy to be very competitive in the entire market. So it's not really a stress; it's something that you all choose to do.
Really appreciate your time. Glad you could join us, and thank you for your lovely analysis of some of these mega trends.
Thank you.
That's it on this edition of Market Makers. Thank you for tuning in. Thank you for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.